So next up here, Javed Jussa, who is, well, what is your title? I don't know what your title is exactly, but I've known you for so long.
Yeah, just quant research.
Quant research at Wolfe Research, one of the best quantitative research departments that you're going to find out there. They've written a couple papers on our data over time. They've got a lot of really interesting strategies. But Javed is going to talk about one very interesting strategy that looks at takeover targets using some of these new methods. And I have a little bit of a longer bio. Responsible for Alpha Signal, Big Data, ESG, and Small Cap Research. Previously, U.S. head of quantitative strategy at Deutsche Bank, where much of the Wolfe research came from. Held roles at Macquarie, CIBC World Markets, and IBM previously. So, thanks, Javed.
Thanks, Lee. I know my topic was originally on machine learning takeovers, but we had recently published a piece of research on just machine learning in general using XGBoost. So I thought I would change the presentation format slightly and just talk a little bit more about the model. And then I think the audience can apply the model to the different techniques or trying to predict different things like takeover targets or whatnot. So I'm going to talk about our machine learning model. It's called Malta. I forgot what it stands for, but it's a country in Europe, and it has an acronym. But it's the first thing I will say is that we developed a machine learning model about in 2012. It's had strong out-of-sample performance from 2014-15 onwards. I'll explain to you a little bit about the model. And again, it is a model, and you can use it for many aspects. But let me get to the heart of the model a little bit. If you don't know about Wolfe, we are a quant research shop. We do research. We do quantitative equity models. We do macro models, and we'll also provide customized solutions for clients. This is just a little bit about Wolfe. So here it is. It's called Malta. Now, I want to just sort of explain the model a little bit. So in a traditional sort of linear model, you tend to have your forward returns, and you tend to have your factors, and you do some feature selection. But essentially, you're trying to estimate the predictors of forward returns. So you have the whole cross section of your stocks, and then you have all your features, and you do all the shebang. You try to weight your exposures in certain ways and all that kind of stuff. This is a little bit different. This is a classification algorithm. So it's somewhat analogous to like a logic regression. But essentially here what you do is you try to classify outperforming stocks from underperforming stocks. So that's sort of the fundamental difference. There's a few unique features of the model. Number one, it's a machine learning model, so it's pretty systematic. There's no discretionary overlay by any means. Number two, it's not a black box model. I would not classify it as sort of a black box model. It's more of a gray box model. So there is transparency in the model. In a linear model, you can see the factor exposures. You can see how they change over time. Here you can actually see what we call the weak classifiers. So it is a transparent model. It may not be as transparent as a linear model, but it's definitely not a black box model. The other thing I want to mention is the model evolves over time and learns over time. And we have many sort of different training samples in the model. And the model also is not as susceptible to overfitting as a traditional linear model, which is another advantage. And it also deals with multicollinearity in a unique way. But let me just sort of explain at a high level how the model works. Essentially, what you do is you break your stock groups into outperformers and underperformers. So this is what you're trying to classify. Next, what you do is you have a factor library. So we've got 300, 500 different factors or features, and then we're going to pick one feature or one factor at random, and we're going to see how well it classifies outperformers from underperformers. So let's say we have 500 features. We do one feature, and essentially we get similar to like a correlation or a rank correlation. As this feature, it basically tells you how well this feature classifies outperformers from underperformers. So let's say it's an estimized metric. So we say, okay, this is how good it classifies outperformers from underperformers. Then you take the next feature, and you take these features at random. There's no ordering them here. You take the next feature, and basically you see how well it classifies outperformers from underperformers. And then you give it a rank correlation, or you give it a metric. And then you do this to all your features. And you do them independently on a univariate basis. And then basically you have a ranking of all your features and how well it classifies outperformers from underperformers. And then you take the one that best classifies outperformers from underperformers. Let's say it's ROE. So we would term ROE, or we coin ROE as our first weak classifier. And then what you do, and this is sort of the unique aspect of the model, is that you take the stocks that were correctly classified by ROE, and you downweight those stocks. And you increase the weight of the stocks that were misclassified by ROE. So essentially what you're doing is, in the next round of training, you are focusing the boosting algorithm on the misclassified stocks. And what this also does is, so let's say ROE was the first weak classifier. You take ROE and you stick it back in the bucket. And then what you do is you add in more factors, and you continually see which one is the second weak classifier, and then you continually do the re-weighting of the system, of the portfolio. And usually you start off with equal weight. But essentially what this does, it keeps targeting the misclassified stocks. And then, you can decide how many sort of features that you want, but every single feature is also downweighted because you are changing the weight of the portfolio and you're focusing on the more misclassified stocks. And this is sort of another way of dealing with multicollinearity, because it's very unlikely that a feature would be selected twice, definitely not right after each other, because each feature has a different payoff pattern. But that's actually the crux of the model. Now, we had built this model, we hadn't used any sort of R libraries or Python libraries. And the reason we did this is because we actually, that's sort of the structure of the model, but there's a lot more, ingenuity, I think, that we put into the model. So the first thing is the model can definitely classify the nonlinear payoff pattern of factors really well. So, basically, let's say we have a factor like earnings revision, and let's just say this is tercile, so this is the top tercile, this is the bottom tercile. A linear model will along the top tercile and maybe short the bottom tercile. But, what about this tercile right here? You generally don't want to short this tercile, you probably want to short this tercile. So you have a sort of a non-linear factor payoff pattern. And even a better example is something like cash over total assets. If I've got cash over total assets, or I have accruals, I don't want a company with too much cash over total assets, because you're not using your capital effectively or efficiently. I don't want a company with too little cash over total assets, because it's risky. So I want a company which has sort of the right amount of cash over total assets. And then you sort of see this nonlinear factor payoff pattern. And what this algo will do is it'll take a nonlinear factor payoff pattern and it'll map it to a linear factor payoff pattern. So it'll take something like this and leave it as the top tercile. It'll take something like this and move it to the bottom tercile, and take something like this and move it to the middle tercile. So it will reshift the payoff pattern. And essentially, when you have a factor coming in, and let's say the factor belongs to tercile 2, instead of not doing anything to the factor, it will actually it'll make a short bet on the factor. If a factor comes in at tercile 1, maybe it'll downweight a little bit. But essentially, it'll take a nonlinear factor payoff pattern and it will reshuffle it to more linear factor payoff pattern. Now, of course, the factor payoff pattern will change. Cash over total assets, I guess, is a good example, because during the financial crisis, you may want a company with a lot of cash over total assets. So that will evolve over time, but that depends upon your training window and all that. So the model will sort of adapt to that as well, depending upon the type of training window you employ. So here, we talk about how the factors get downweighted in the model. But I think what's more important is you can actually see which factors are classified as a first week classifiers, as a second week classifiers, etc. If you were to, if you were to do this for all companies and look at this in a time series fashion, you'll generally see, value factors, quality factors, whatnot, and you can see during different markets, maybe more technical factors will show up as, as the first week or the second week classifier as the market gets more volatile. But you can sort of, you can do further analysis on this. But the point here is that we have transparency in the model. And it's not as susceptible to sort of overfitting. Each factor is subsequently downweighted. If you look at this as well, you can see that it's not as susceptible to overfitting as a traditional linear model. And it is due to this downweighting of the factors. But what you see here, when you're actually looking at it, this is Japan, it's a market rampant with nonlinear factor payout patterns, is as you add more factors into the model, you do get better performance. But the cost, but after you add in 25 factors or 20 factors, you don't see that incremental improvement in performance. So again, and you can see it on a risk-adjusted IC basis. This is rank IC, but the same will apply for if you look at CAGR or Sharp. You don't see much improvement as you add in more and more factors. And again, the more, the next or the end factor that you add in is downweighting. So that's one feature of the model. Another feature that I want to talk about is the training window. So when we're sort of thinking of the training window, the baseline training window is about 12 months. And it's to sort of capture persistency in the market, which is very important for quants. And you can, as you add in, as you increase that training window, you do get better performance. But again, the drawback is you probably have less selection of factors as well. We've chosen 12 months as our sort of baseline medium-term training window. But as you increase that training window, like a linear model will typically maybe have 120 months, but you will see better performance. But again, you may not be able to use more alternative data factors or whatnot because you don't necessarily have the history for it. And again, this is Japan. Another interesting thing is how we deal with seasonality. So we don't include like a dummy variable or whatnot. We actually do it in a very unique way. But if you were to take that model, that medium-term model, and if you were to plot the performance by month, this is the performance for US, this is the performance for Japan, and this is by month. And what you'll see is, and again, the market always goes up, but what you'll see is January is the worst month. And that is for the US. If you look at Asia ex Japan, you'll see that February is the worst month. And again, this is just the January effect, where there's a risk-on episode in January typically, and quant strategies tend to underperform. In Asia ex Japan, maybe because of Chinese New Year's, you see that as a February effect. So how do you deal with that? One way to deal with it and how we deal with it is we actually create a training sample of Januaries. So we look back a number of years and put all the Januaries as a training sample, all the Februaries, all the Marches, etc. So essentially, we're gearing the model to train on the monthly effect. And if you do that, you're going to sort of see an improvement in the performance. And essentially, you don't sort of see that January effect occur. You can do the same thing. You can see the same performance for Asia ex Japan as well. So that's sort of a seasonal model. So the baseline model or the medium-term model is a 12-month model. We also incorporate a seasonal model. Now, there's also an interesting, another model that we actually incorporate as well. It's called a hedge model. And if you look at this right here, this is the performance of the medium-term and the seasonal model in summer of 2016. And this is in Japan. And what you'll see is that the medium-term and seasonal model underperformed, but the hedge model, I'll explain what the hedge model has actually outperformed. And what the hedge model is, it's like an anti-model. What you do to form the training sample of the hedge model is you look back at the performance, and you see where the model has underperformed. And actually, we do use a bit of discretionary input there. We basically say where the model has a rank IC of 5% or less is where it's underperformed. But again, you can do a more systematic. There's a more systematic way of doing that. But essentially, what we're doing is we're taking the time periods where the model has underperformed and forming a training sample out of that. So it is very much like an anti-model. And again, it will save you in certain circumstances, depending how you weigh the model, in these periods of sharp factor rotation. And you can sort of see that here as well. During this time, the medium-term model and the seasonal model underperformed. This is July and August 2016, but the hedge model outperformed. So we combine these different training samples. We take the 12-month, we take the seasonal model, and we take the hedge model and combine it together to form a more robust model. And you can sort of see here the difference between the baseline and the enhanced model, which includes the hedge model, is lower maximum drawdowns. So this is just a comparison of the baseline and the enhanced model, and we'll see a higher risk-adjusted rank IC as well as a higher Sharpe and a lower drawdown. Another thing that we also do to capture sharp changes in the market is we add a 1-month model as well. So we have a 1-month model as well, and so essentially we have a medium-term, a seasonal, hedge, and short-term model. We combine all the models together to form multi. And again, I don't remember what it stands for, but essentially that is a combined model. Again, it has, it takes into account seasonality in sort of a unique way. You can see all the weak classifiers, so there is transparency in the model. You can also, it also deals with multicollinearity in a different way as well. Now, the model turnover is very high. I don't think I have it here. This is just more performance of it. But again, the model turnover is actually very high. So we cover about 12,000 stocks, just shy of 12,000 stocks. We cover all markets. So Russell 3000, S&P TSX Composite for Canada, and S&P BMI X North America for world. We just don't cover frontier markets. This is a picture of the payoff pattern. So this is the average annualized return. And what's interesting is you sort of see the bottom quintile has a negative return, which is uncommon if you ever look at, if you look at the fact performance. The markets generally goes up, but we still have a negative return on quintile 1. It's actually good at selecting underperformers. You can combine this with a linear model as well. We have a linear model called LEAP, or a more linear model. And what you will generally find is the Malta model, a more non-linear model, will tend to perform better in markets where you have more non-linear factor payoff patterns, so Japan and the US. A traditional linear model, or a more sophisticated linear model, will tend to perform slightly better in markets like Europe, where you see more of a linear factor payoff pattern. The interesting thing about something like a classification model is it's also good for fundamental PMs, because a fundamental PM wants to maximize their hit rate, and rather than sort of taking a linear model and estimating what you think the return is going to be, you want to really maximize your hit rate, and that's why I think this classification model is appropriate for fundamental managers as more of a stock screen. Another thing is that the model has high turnover, but I think it's fairly easy to customize for longer investment horizon, or someone who can't for investors who cannot swallow such a high turnover. And what you can simply do is, instead of training it on next month's return, you can actually train it on next 12 months return. So its feature selection will be for next 12 months return. That will naturally reduce the turnover, but that's another way of actually lowering the turnover of the model and making the model more appealable for investors that have a longer term horizon. Now, another thing that you can also do is you can actually make the model, you can calibrate, you can gear the model for shorter term horizons. So another way you can do this is you can actually take the model and train it on 1 week ahead returns. Now, you have to think a little bit differently about training a model on 1 week ahead returns, because when you're training a model on 1 week ahead returns, the fundamental factors don't necessarily explain the variance of stock returns at a weekly frequency. It's kind of like taking fundamental factors and trying to explain next day's return. So what you do is, if you're trying to train the model for 1 week horizon or a shorter horizon, what you can actually do is, instead of using fundamental factors, you can use technical factors. So that's one thing we also do, is we use technical factors. So not momentum, but like Williams percentage R, Bollinger Bands, things like that. But when you use technical factors, you have to use them a little bit differently than you would with a traditional fundamental factor, because technical factors only mean something based on the stock's own universe. So whereas in a traditional factor set, you would just take a factor and normalize it cross-sectionally, with a technical factor, you need to normalize it in a time series sense across the stock's own history. And then you can normalize it cross-sectionally. But the point is that we can gear the model to a higher frequency, a shorter investment horizon, by one, changing the window that we're calibrating the model on, and two, changing the inputs of the model as well. So meaning use more technical related factors. And I think that's it. Again, what I wanted to show you here was more of the topology on how we actually take our AdaBoost, XGBoost model and use it for stock selection, and essentially also the differences between a linear model and a nonlinear model as well. Any questions?
When you're predicting nonlinear patterns, the real pattern is linear. Your model will still predict a linear pattern, right?
Yeah, no, exactly. So
then why should it not work in Europe? Why is it worse than a linear model in Europe? Because that was the argument.
Yeah, sorry, can you repeat that question again?
So if you're also predicting the linear pattern correctly, why should this model be worse than the linear model? And the example you gave was Europe.
Oh, it's not predicting the linear model incorrectly. It is better addressing the nonlinear factors. So it better addresses the nonlinear factor payoff patterns. So what we think is that if you're in sort of like a market like Japan, where you do have a more nonlinear factor payoff pattern, then it'll work better there than in a region where you have more linear factor payoff patterns. So it maps it from a nonlinear sense to a linear sense, but I guess in a sense when you don't necessarily have that nonlinear factor payoff pattern, it just generally keeps it in a linear fashion. So that's what we think why it works better in Japan and Europe and whatnot.
Question, like I think about page 18 or something, or 17, this IC curve.
Yeah.
It looks like there's like this steep decline in the power of the model. Like 15, 19. I'm talking about them, you have a plot of the IC going down over time.
Okay.
Yeah.
Okay. Yes.
Right.
Yeah.
So it looks like maybe it's even hitting year 0, right? So
yeah.
The question is, in connected to the other one, we have a hedge model that basically comes into effect when it's under 5.
Yeah.
So it looks like the hedge model has been in effect since early 17. Would that suggest like this model doesn't work anymore and you should bet the other way, or I don't know.
Right. No.
Yeah.
So first of all, you make a very, very good point. So A couple of things. The hedge model is a component of the model, and it's not weighted the same because if you look at the hedge model, it would tend to underperform the baseline model. So the way we weight it is sort of two sevenths on the 2/7 on the medium term, 2/7 on the short term, 2/7 on the seasonal, and then 1/7 on the hedge model. So we downweight the hedge model, but it's a fixed weighting essentially in the overall model.
That's actually overall with the hedge model.
Yes, correct. Yeah, and then actually you raise a really good point because you do see a decline in the performance of the model. This is rank FC, but this is also an advent of all the factors as well. So like we have this big factor library. So Titman invented the momentum in whatever 93, but we'll still have that as a factor there. Prior to that. So like Sloan's accruals. What I mean? It was in 96, but we'll still sort of has a factor. So any sort of back testing, you'll sort of see this effect. You'll see a decline in that.
Okay, that's fine. And the second one is you said about the weekly versus daily rebalance. On the daily, you have higher return, right? And the weekly rebalance. It's
a weekly rebalance. Sorry, not daily rebalance. Yeah.
You get a weekly and you said something about if you have a daily rebalance, then higher, right? One towards what end?
Yeah. So if we train the model on weekly returns.
It's training.
It's training, yeah. It's training model, yeah. Yeah.
Javed, you mentioned if you train at a 2-month returns, obviously the fully turnover would also drop. But obviously fully return will also decline, right?
Mm-hmm.
And so the question is actually in terms of your experience, like horizon, sort of like experience, like a empirically observed, what is sort of like a
the optimal.
If any, to bring up, so what do you find the most effective, or what is the momentum of those factors that's persistent over time?
Yeah, so it will depend upon transaction costs and all that kind of stuff. But like, if you're, some clients like the weekly model because they don't necessarily have transaction costs. So it's much better to gear up a higher turnover model for them. Some clients who face transaction costs or an annual turnover constraint cannot do this. So we would do the higher capacity model. We train it on a longer window. So it all depends upon how you can, what your transaction costs are, how you can swallow it, how you do your portfolio construction, how you use the model as well. So it depends upon each client, I would say. Any more questions?
I'll take the slide where you train adapters. So when you keep adding features to other momentum, you see that improvement on each step becomes less and less, and the complexity grows. So how do you stop it?
We just set a fixed number of factors. So we meaning that we stop it at, I believe we stop it at 30 or 35 factors.
So you have like fixed amount of steps.
Meaning that let me just clarify. We have 500 features or whatever, how many features. So our factor universe is abundant. But as we're doing the training and as we're getting the weak classifiers, we stop at around 30 or 35 factors, meaning that and this is static across the entire time series, meaning that every single point we'll stop it at 30 or 35 factors.
Did you try to stop it by cross-validation?
No, we didn't do that. We had done this a while ago, but there you can do some optimal point of figuring out when's the best set of factors, and what we try to do is just sort of hunt for better factors. We just sort of make a fixed stop at 30 or 35 factors. But you can do exactly what you suggested.
No, I just did so. That's why.
Yeah. Okay. What's your? Is it static?
No, actually, by chance, I was just doing nearly exactly what you were describing.
Okay, but you're adding a cross-validation.
I used to solve it by cross-validation.
Mm-hmm.
And actually, typically cross validation tells you to stop much earlier.
Yes. So we actually, if you do, I don't have the slide here. I don't have the slide here. So you could, you could see it at 7 or 8 factors. You know what I mean? Like that's what we've done. Like that's what we've kind of shown. If you take a simple, a simple model, but you can take your entire factor set after 7 or 8 factors, you generally sort of don't see that much incremental performance and improvement.
I thought there was another one more approach. You can stop it by some sort of information, like archaic. You know what is archaic information? It's just relation between the complexity of the model and its precision.
Okay.
And it has, at some point, it will have enough.
Okay. Thank you.